If you want to understand what's really happening right now, stop watching the loudest headlines. Start watching the quiet signals most people ignore. Here's what I mean. A shocking story can go viral overnight. An operation, a raid, a dramatic claim about oil, power, and presidents. And whether it's true, half-true, or completely made up, it still does the same job. It hijacks your attention and makes you feel like the world is changing in one explosive moment. But real shifts in empires and real shifts in your financial future almost never happen like that. They happen the way a house goes bad. Tiny cracks first, a little warp in the floorboards, a monthly bill that used to be manageable suddenly isn't. The kind of change you don't notice until you can't unsee it. So instead of chasing the most dramatic story, what if you looked at the numbers that can't go viral because they're too slow, too boring, and too revealing? In the next few minutes, I'm going to show you a simple lens that turns random news into a readable pattern. And once you see it, you'll start spotting what's coming before the crowd does. Most people are trained to look at the world event by event. A war here, an election there, a market crash, a stimulus package, a new law, a new villain. Mainstream media reinforces this by design. Every story is framed as isolated, urgent, and emotional. Someone is to blame. Someone must respond. Something must be fixed, right now. But that lens is shallow. It treats symptoms as causes and moments as explanations. What it never asks is the harder question: what system produced this outcome in the first place? Because once you ask that, the story changes completely. Instead of, why did this happen? You start asking, at what stage was this inevitable? Economic stress, political tension, military pressure, social division, these aren't random failures. They're downstream effects of long-term structural choices. Debt structures, incentive systems, currency design, power maintenance. Think about it this way. If your car engine has been overheating for years, the breakdown on the highway isn't the real problem. It's just the moment everyone notices. Most commentary focuses on the breakdown. Very little focuses on the overheating. That's why people feel constantly shocked, confused, and reactive. They're being shown snapshots, not systems. Drama, not architecture. What I'm going to do next is shift the lens, not to panic you, not to impress you with theory, but to give you a way of seeing that makes the chaos feel oddly predictable. When you're ready, we'll move into the hard data, the part where trust is earned, not demanded. Let's slow this down and ground everything in verifiable reality. No speculation, no cinematic storytelling, just numbers, timelines, and public records. First, U.S. government debt. As of recent Treasury data, U.S. federal debt is above $34 trillion, having crossed that threshold in 2024. What matters more than the headline number is the trajectory. Over the past decade, debt growth has accelerated faster than GDP growth, meaning the country is adding obligations faster than it's adding productive output. Now look at interest. For the first time in U.S. history, annual interest payments on federal debt have exceeded $1 trillion. That number used to be a footnote. Today, it rivals or exceeds what the U.S. spends on national defense. This is not hypothetical. It's a line item in the federal budget. Next, deficits. Even in years without recessions or major wars, the U.S. is running structural deficits, spending more than it collects during relatively good economic conditions. Historically, deficits were meant to be temporary. Increasingly, they're permanent. Now, zoom out globally. According to IMF and World Bank data, central banks worldwide have been diversifying reserves. The US dollar still dominates global reserves, but its share has declined steadily over the last 2 decades. This isn't a collapse, it's a gradual rebalancing. At the same time, gold purchases by central banks have surged, especially among emerging economies. Again, this isn't ideology, it's reported balance sheet behavior. Then there's capital movement. Multiple international wealth reports show record levels of high net worth individuals relocating assets or residency over the past few years. This includes moves from traditionally stable economies into jurisdictions perceived as more predictable in taxation, regulation, or currency exposure. Finally, inflation. While inflation has cooled from its post-pandemic peak, price levels have not returned to pre-2020 norms. Everyday costs, housing, insurance, healthcare, education, remain structurally higher than they were just a few years ago. Even as wages struggle to keep pace, none of these facts require a conspiracy theory. None require believing the system is about to collapse tomorrow. They simply describe a system under long-term pressure. And pressure doesn't tell you what will happen next, but it does narrow the range of possibilities. Next, we'll interpret what these facts may mean when viewed as parts of a larger system, not emotionally, but strategically. When you line these facts up side by side, something important emerges, not a prediction, but a directional signal. One possible interpretation is that the United States is entering a phase where financial flexibility is narrowing, even though outward strength still appears intact. Here's why that matters. In earlier decades, rising debt was offset by rapid growth, favorable demographics, and expanding global influence. Today, growth is slower, populations are aging, and global systems are more multipolar. That doesn't mean decline. It means trade-offs become harsher. Every system under constraint adapts. Governments do this too. When borrowing becomes more expensive, leaders face limited options: cut spending, raise taxes, inflate away obligations, or restructure expectations. Historically, systems tend to choose the path that is least immediately disruptive, even if it carries long-term consequences. This often means tolerating higher inflation rather than dramatic resets. Another strategic lens is who benefits from this environment. Debtors benefit when money loses purchasing power. Large institutions and asset owners adjust more easily than wage earners. This doesn't require malicious intent. It's a mechanical outcome of how financial systems respond under pressure. At the global level, diversification away from a single currency doesn't necessarily signal rejection. It signals risk management. From this perspective, what we're seeing may not be panic, it may be preparation. And preparation tends to start at the top first. Another possibility is that this phase reflects a transition period, not an endpoint. Dominant systems rarely collapse outright. They evolve. The key takeaway here isn't something terrible is guaranteed to happen. It's this: when a system's incentives change, behavior changes with them. Understanding that shift is the difference between reacting late and positioning early. In the next section, we'll zoom out even further. When pressure builds inside a major system, the effects don't stay contained. They ripple outward, through markets, institutions, and eventually daily life. Start with financial markets. Extended periods of debt and monetary intervention tend to increase volatility. Even when headline indices look stable, asset prices become more sensitive to policy signals than to fundamentals. Markets don't just react to earnings anymore. They react to interest rate expectations, liquidity signals, and government guidance. Next, banks. In a constrained environment, banks become more cautious. Lending standards tighten. Credit becomes more selective. This doesn't always show up as a crisis. It often shows up as friction. Small businesses feel it first. Households feel it through higher borrowing costs and stricter approval processes. Then, currency. When governments face persistent deficits, currencies often experience gradual erosion rather than sudden collapse. Purchasing power slips quietly. People don't feel poorer overnight. They just notice that the same income covers less over time. This is psychologically powerful because it delays backlash while compounding impact. Now, zoom out to governments. As fiscal pressure increases, political systems polarize. Not because people suddenly hate each other, but because scarcity sharpens trade-offs. Every policy choice creates visible winners and losers. Compromise becomes harder, messaging becomes louder, governance becomes more reactive. Finally, the global order. Periods like this often coincide with rebalancing of influence. Not the end of one power, but the rise of several others. Trade becomes more regional. Supply chains shorten. Strategic resources matter more than abstract financial efficiency. This doesn't mean globalization disappears. It means it changes shape. What's important to understand is that none of these consequences require a single dramatic trigger. They emerge from cumulative stress. Like tectonic plates shifting beneath the surface, the movement is slow until suddenly it isn't. For individuals, this can feel disorienting. The rules you grew up with still exist, but they don't work the same way anymore. That's why the next step matters most. Translating this macro-level pressure into what it actually means for your own life, choices, and sense of security. Big systems only matter if they touch your real life. So let's translate this out of charts and policy language and into everyday experience. Start with savings. When inflation runs above wage growth, even modestly, cash savings quietly lose purchasing power. Nothing dramatic happens. Your bank balance doesn't drop. But over time, what that money can do for you shrinks. This is why people feel like they're doing everything right and still falling behind. Now, investments. Markets in these environments tend to reward assets over effort. Ownership matters more than income. Long-term planning becomes harder because traditional assumptions, like stable interest rates or predictable returns, don't hold as consistently. Volatility isn't just noise anymore. It becomes part of the system. Jobs come next. Companies respond to uncertainty by protecting margins. That can mean automation, restructuring, or shifting costs downward. Even well-paid professionals can feel less secure, not because they're underperforming, but because decision-making becomes more centralized and less forgiving. Then, cost of living, housing, insurance, healthcare, and education aren't just getting more expensive, they're becoming less flexible. These are costs you can't easily substitute away from. When they rise faster than income, households absorb the pressure through lifestyle changes, delayed plans, or increased debt. And finally, family decisions. People delay buying homes. They postpone having kids. They take on more responsibility for aging parents. These aren't cultural shifts, they're economic adaptations. Families are adjusting to systems that feel tighter, less predictable, and more demanding than they used to. None of this means collapse is imminent. It means the environment has changed, and many people are still using a mental map drawn for a different era. The danger isn't fear. The danger is using outdated assumptions. In the next section, I'll introduce the framework I personally use to make sense of periods like this. Not to predict headlines, but to stay oriented when systems shift. This is where information turns into judgment. Over time, I've found that most people don't fail because they lack data. They fail because they lack a consistent way to interpret it. So instead of reacting to every new headline, I use a simple mental model I call the structural lens. Here's how it works. The structural lens ignores personalities, politics, and daily drama. It focuses on 3 questions. 1. Incentives. What is each major player rewarded for doing? Governments, banks, corporations, households, everyone responds to incentives. When incentives change, behavior follows. 2. Constraints. What can't this system do anymore without breaking? High debt, aging demographics, geopolitical commitments, these limit options, even for powerful actors. 3. Adaptation paths. Given those incentives and constraints, what responses are most likely, not most desirable? Systems tend to choose paths that minimize short-term disruption, even if they create long-term cost. Using this lens, you stop asking, is this good or bad? You start asking, given the structure, what would I expect next? That shift is powerful. It removes emotional whiplash, it reduces overreaction, and it helps you distinguish noise from signal. Most importantly, it builds trust with yourself. You're no longer borrowing certainty from headlines or commentators, you're developing your own internal compass. This framework doesn't predict exact outcomes. It narrows possibilities. It keeps you grounded when narratives swing from optimism to panic and back again. In the next section, we'll turn this way of thinking into practical behavior. How to prepare, observe, and reduce risk without trying to outsmart the entire system. Big systems only matter if they touch your real life. So let's translate this out of charts and policy language and into everyday experience. Start with savings. When inflation runs above wage growth, even modestly, cash savings quietly lose purchasing power. Nothing dramatic happens. Your bank balance doesn't drop. But over time, what that money can do for you shrinks. This is why people feel like they're doing everything right and still falling behind. Now, investments. Markets in these environments tend to reward assets over effort. Ownership matters more than income. Long-term planning becomes harder because traditional assumptions, like stable interest rates or predictable returns, don't hold as consistently. Volatility isn't just noise anymore. It becomes part of the system. Jobs come next. Companies respond to uncertainty by protecting margins. That can mean automation, restructuring, or shifting costs downward. Even well-paid professionals can feel less secure, not because they're underperforming, but because decision-making becomes more centralized and less forgiving. Then, cost of living, housing, insurance, healthcare, and education aren't just getting more expensive, they're becoming less flexible. These are costs you can't easily substitute away from. When they rise faster than income, households absorb the pressure through lifestyle changes, delayed plans, or increased debt. And finally, family decisions. People delay buying homes. They postpone having kids. They take on more responsibility for aging parents. These aren't cultural shifts, they're economic adaptations. Families are adjusting to systems that feel tighter, less predictable, and more demanding than they used to. None of this means collapse is imminent. It means the environment has changed, and many people are still using a mental map drawn for a different era. The danger isn't fear. The danger is using outdated assumptions. In the next section, I'll introduce the framework I personally use to make sense of periods like this. Not to predict headlines, but to stay oriented when systems shift. If there's one thing to take away from this, it's not fear, it's orientation. Nothing we discuss today means the system suddenly stops working tomorrow. It means the conditions have changed, and systems respond to conditions whether we notice them or not. Most people spend their lives reacting, adjusting only after pressure becomes unavoidable. A smaller group pays attention earlier, not because they're smarter, but because they're watching structure instead of spectacle. Once you start doing that, the noise loses its grip. Headlines feel less overwhelming. Market swings feel less personal. Decisions become quieter and more deliberate. This isn't about abandoning trust in institutions or betting against your country. It's about understanding how large systems behave under strain and making sure your life isn't built on assumptions that no longer fit reality. Awareness doesn't guarantee outcomes, but lack of awareness almost guarantees regret. The goal isn't to predict the future. It's to be ready for more than one version of it. If this way of thinking helped you see the world a little differently, stay with the channel. In the next video, we'll break down the specific signals that indicate when systems move from stress into true constraint, and how to recognize them before they show up in headlines. That's where real preparedness begins.